When people think of double-digit dividend yields, they think risk. And well, they should, because the market is often wrong, but it's never stupid. And what that means is if a stock is priced at a steep discount or a very high yield, it often has a good reason for that. And sure, a stock could be 7, 8, 9% yielding and not necessarily be high risk because, again, it's pricing in a market average return over the long term. And maybe it's just a company that doesn't have any growth prospects, or maybe it's a preferred stock or a bond. And so a 7 to 9% yield doesn't necessarily mean risk. But if it's priced at a double-digit yield like 11% or even 10%, there's usually at least a little element of risk there, because if it can just pay that dividend indefinitely and maintain its intrinsic value otherwise, you're going to get upper level or even higher than market level total returns over the long term without even accounting for the potential for valuation multiple expansion or even obviously any kind of growth if it's a common equity. And so that is a pretty compelling bargain if there isn't much risk, but it usually means there's at least a moderate amount, if not a high amount of risk. But in today's video, I'm going to talk about 2 high yield stocks where I think their yields are quite sustainable moving forward. And I think there's a lot of underlying strength in the business model that could drive additional growth over the long term and at the very least make their yields very sustainable. Before I get into these 2 picks, if you could please give this video a like, that'd greatly aid in its distribution. Thank you very much. Okay, so the first stock I want to talk about is a business development company, the Morgan Stanley Direct Lending Company, or ticker symbol MSDL. It's a relatively new stock in terms of its IPO was just earlier this year. It was a private BDC for several years before that, but it's fairly new to the stock market, and it's experienced a lot of headwinds because it has these lockup expirations for people who held the BDC when it was privately traded. They have to hold their stock for a certain amount of time, and that each of these lockup expirations comes up, they can sell more and more of their holdings. It gives them a public liquidity, a chance to exit the stock. If they've been in it for a long time, maybe they want the proceeds for something else. A lot of them are institutional investors or high net worth individuals who maybe want to liquidate it to buy a house or a boat or who knows what else, or maybe they just want to invest in a new strategy. And so when these expirations come, it usually means a mass amount of sellers flooding the market and causing the stock price to dump. It still has a couple of these coming up all the way through January. And so the market remains a little bit afraid of really getting into it. But I think there's an enormous amount of intrinsic value here, the way the fund is structured, such that I think it could be the next Blackstone secured lending fund, which that's a great BDC, ticker BXSL, that has earned a significant premium to its net asset value and generated a lot of value for shareholders. I think MSDL is structured to do the exact same thing as that. Once it gets through these lockup period expirations, I expect it to do quite well. But honestly, buying today is a good time to buy it because it's discounted due to fears about these lockup period expirations. Sure, it might have some volatility in the near term. We don't know. But either way, you're locking in a nice yield today, and I think you're going to have some significant upside over the next year or two, or at least in the next 4 to 5 years. So why do I like MSDL so much? Well, first of all, it yields about 10%. Okay, great yield. It's covered over 20% by net investment income, which again gives it a nice cushion. Sure, its net investment income is going to decline some as the Fed just cut rates, and it will probably cut a few more times at least. But that's a nice big cushion that makes the base quarterly dividend quite sustainable even in the face of dividend cuts. Another thing I really like about it is it has a very low leverage ratio, below 1 times, which on a net basis especially, which is quite rare for a BDC. It has an investment grade credit rating, so it's very conservatively leveraged. Meanwhile, it also has almost the entire portfolio invested in senior secured first lien loans, which again are very conservative, among the most lowest risk type of middle market investment you can make. That's what BXSL has done as its bread and butter as well. So MSDL is well positioned for an economic downturn by having the cushion to support its dividend through a rate cutting cycle, while also having the defensive investments and low leverage ratio that should help protect net asset value per share more than a lot of peers in a downturn scenario. Yet the high yield, the relatively cheap valuation relative to NAV, those all give it some significant upside potential, as well as even the floating rate exposure in the case that the Fed ever pivots to rate hikes again in the future. That can give it significant outperformance relative to peers in those circumstances. But that's not all, though. There are other reasons I like it. For example, Morgan Stanley's the manager. Okay, they're a pretty good manager. They know a lot about economic markets and the economy, and so that you get benefits from that. But also they have a very large stake in the company of the shares. Morgan Stanley has a large share in MSDL shares, and so they're well incentivized to look out for the interests of shareholders. They can't just milk it for fees like a lot of, or I shouldn't say a lot, but some BDC managers do. Instead, they need to actually be concerned about the welfare of shareholders because they're creating value for themselves. Additionally, they've made the fee structure quite attractive, kind of similar to how BXSL has done. So they have one of the lowest fees of any externally managed BDC in the sector. And so all that to say, Morgan Stanley has a lot going for it. MSDL has a lot going for it in that, again, they're well-aligned management, low fees, high yield that's well covered by net investment income, one of the strongest balance sheets in the space, one of the strongest investment portfolios in the space. I don't know what more you could really ask for. And honestly, if it drops a lot on any of the upcoming lockup expirations, I personally expect to load up on shares because I think there's a lot to like about MSDL, even though I'm not really very heavily into BDCs at the moment. But I think this is a compelling option, especially any future sell-off. Okay, so what is the second fund I'm going to talk about? Well, before I get into that, if you could please subscribe to my channel, I'd greatly appreciate it. Thank you so much. Okay, so the second stock that yields over 10% I'm going to talk about today is Delek Logistics Partners. That's ticker symbol DKL. It's a midstream MLP. It issues a K1, so keep that in mind before investing in it, whereas MSDL does not. It's a 1099 tax form. But it yields over 11%. It just recently sold off because management issued a bunch of new units in order to pay off its credit revolver as well as redeem some convertible preferreds. Now, obviously that's dilutive to some existing shareholders or unit holders, but it really strengthens their balance sheet a lot. They've already made a lot of progress over the past few years with their leverage ratio, gotten it to below 4 times, and this will bring it even lower and make their financial profile even more conservative. Meanwhile, they had room to wiggle with covering the distribution. They had like a 1.36 or 1.38 times, I think, coverage ratio at the end of their last quarter. And so, yeah, this will cause it to dip a bit. But remember, it'll be offset by no interest on the revolver and also the preferreds that they're redeeming. That will offset it at least to some degree. And so they still have plenty of coverage. They just hiked the distribution. Management is bullish about their future growth potential. They just made some big acquisitions that will be accretive to them. So yeah, this will probably offset some of it or maybe even all of it, depending on how the exact math works out. But it's not going to be a death blow. It does not threaten the distribution. It's still very safe. They have strong growth prospects over the long term with these new acquisitions they made, especially like Wink to Webster and H2O Midstream. And that should help them to continue growing the distribution on top of the 11% current yield that you have. Again, the balance sheet's stronger. That really de-risks the business profile when combined with these new acquisitions, which have very well-positioned pipelines in the Permian Basin with credit investment grade counterparties. This midstream partnership is positioned to do quite well for years to come. All the while, you're getting an 11% distribution yield. That again, odds are that it will grow at a much higher rate than the odds are that it will be cut. And so, again, no investment is risk-free, but I think with MSDL and DKL, you get two stocks that have double-digit yields. It should be sustainable for years to come. Have a decent chance of growing, both of them, because they have some good coverage ratios, strong underlying business models that generate stable cash flows. Management seems to be acting prudently to maintain a very conservative balance sheet posture. And so there you have it. Hopefully this video was helpful for you as you look to build a high-yielding portfolio of sustainable high yields that give you that passive income you need to meet your financial goals without taking on too much risk. And if it was helpful for you, please, again, subscribe to my channel, like the video, and share with me in the comments below what you thought about it. Thank you so much. See you next time.